My next guest manages $13 billion, including funds tailored to investors' risk appetite. And something tells me his more conservative funds, got more popular last week, given all that volatility. Well, Rich Weiss, the senior portfolio manager at American Century. And Rich, good morning. Before we get to those broader markets, we got to ask all the money managers about the big news of the day this morning. Of course, Google's announcement that is acquiring Motorola Mobility. Tell me what you think about that.
Well, it'll be interesting to see how it affects the individual companies, but we're excited about it from two perspectives. First, M&A activity in general, and this is M&A with a capital M and a capital A, is generally synonymous with a relatively healthy economy and good things to come and a bull market. And although it remains to be seen whether that's true, it's generally a positive. Secondly, and perhaps more importantly and nearer and dearer to our hearts, we've been overweighted technology and telecommunications stocks and growth stocks in general in some of our portfolios. And this bodes well because whenever you have a deal of this size, it excites the industry. There's rumors that race around, and it causes some good action in that sector, and we're looking forward to it.
Rich, based on this news this morning, would you be adding more to your telecom allocation?
I don't know that we'd be adding more. We're already overweighted in telecom technology and, again, other growth stocks in general. So we'll wait to see what happens. But that should benefit our balanced portfolios in general.
Well, let's turn to the broader markets now. We had a very volatile week, clearly. Some of the more conservatively positioned portfolios definitely outperformed sort of the growthier, sort of more risky portfolios. Tell me what you expect. I mean, a lot of analysts still bullish on the S&P, looking for a 1,400 target approximately by year end. What's your view?
Well, we're relatively bullish on equities for a couple of reasons. The economy is certainly down or decelerating, but it's not out. There are spots in corporate America and in some of the housing sectors, housing starts. There are economic stats that are still showing signs of life, deceleration aside. You add to that the fact that Chairman Bernanke's made it clear the Fed stands ready to do whatever it can. And when you add all of that up, despite investor and consumer sentiment, which clearly needs a jump start, but it's notoriously very fickle, and that could happen at any time. Equity market valuations are compelling. They have been for some time. They remain so, and that gives us a good reason to stay healthily weighted in equities. We're not overweighted, except for the sectors we talked about a minute ago, but we're relatively optimistic as far as some of the risky assets go. With that said, of course, we remain well diversified across asset classes in our balanced portfolios, including alternative assets, just to be sure.
Rich, very quickly, we got about 20 seconds here. Where do you expect the S&P to end up at the end of the year? Are you looking for an 18%, say, gain from now until year end?
It's hard to see that kind of room. And it's hard to predict that short term. But, yes, we're definitely looking for it to end in the black. So we're looking towards the end of the year very optimistically.
All right. Thanks so much for joining us here and taking the time to join us on In the Loop. Rich Weiss of American Century.